Hello, everyone, and happy Friday. It's PJ Patterson here for Market Update. It is, as I said, Friday, the 7th of May. Unbelievable that we are already into May, and man, how fast the year is going by. Just incredible. Anyway, top three things today are going to be the U.S. dollar and a quick conversation around the U.S. dollar and inflation, earnings, and then I'm going to touch on something that I don't talk a lot about. I have mentioned it from time to time, but it's volume. So stock market trading volume and some interesting metrics. There's been a lot going on, and certainly, as you can see here on the screen, the chart of the U.S. dollar kind of tells the story. The U.S. dollar, as you know, we have talked a lot about the U.S. dollar, and the strength or weakness of the U.S. dollar drives a lot of other asset class strength or weakness, and that has to do with the correlations of the U.S. dollar. I'm not going to put the correlations chart up, but needless to say, the dollar is very heavily correlated to a lot of asset classes around the world, and that's why in global macro, if you get the direction of the dollar right, you're going to get the direction of a lot of other stuff right. And so this is borne out in, now this is an interesting chart of the dollar versus the S&P 500. As you can see, they have diverged, the dollar heading down and the U.S. S&P 500 index heading up. So quite a bit of a divergence there. Oh, there's a little snippet of the inverse correlations there. But nevertheless, look, the point is, and I've made this point many times, is the dollar, first of all, is in a bear market. It does not do well in quads 1 and 2, and it doesn't really do well in quad 3. It is a quad 4 asset. Just checking to make sure the mic is on so that I'm not sitting here talking into nothing. So anyway, the dollar heading down. We had a little bit of a spike in the dollar, as you can see there, late April, early May, and that drove a lot of that, a bit of a sell-off in energy, a bit of a sell-off in the small caps, just a bit of a sell-off in the markets in general. That, as you can see, though, was very short-lived. It was a counter-trend bounce. We pretty much knew that. We sold that rally in the dollar by buying other stocks or just holding on to the stuff that we already owned. And of course, as you can see here, the dollar has just resumed its downtrend. So pretty clear sign there. The dollar is continuing its downtrend, will most likely continue to do so. The corollary of that, or the sort of, not the corollary, the inverse of that, or the upside down of that, is the Commodities Index. Look at this thing. This is just a rip-roaring bull market. It doesn't get really any more bullish than this. As you can see, starting way back in July, thereabouts, July, August of 2020, we began to see the commodities market begin sniffing out that we were going to begin to see a dollar decline. And again, look at that. Dollar peaked around July, August of, well, really July of 2020. So the downturn in the dollar sort of began. And then, of course, the commodities upturn began in earnest as well. And it's just continued. So we saw this consolidation here. I think I talked about this possibly last update or maybe 2 updates ago. This area here was circled, and we basically just saw a consolidation, and just so happens that would have, sorry, let's get my dollar index up, correlated nicely to this little pop in the US dollar. Now, what was interesting, the dollar popped, but the commodities chart kind of just went sideways because the commodities are going, sorry, dollar, don't believe you. We're just going to kind of hold tight here, see which way you break, because we think you're going to break down. And of course, the dollar obliged and broke down, and off to the races in the commodities sector we go again. So there you go. Now, I just want to touch on earnings. A lot of the S&P has now reported. Look at this. I mean, across the board, you're seeing green almost everywhere. Epic earnings growth. I touch on this because, of course, we're in earnings season right now. We're getting a lot of companies reporting. Probably this coming week, we'll get the final sort of 100-ish companies reporting. I think there are a few that reported last night, and then there'll be a few probably that report Friday as well. So anyway, when I show this next week, hopefully it'll be on almost 500. But anyway, solid earnings growth across the board, and the market still has not fully priced this in. And that's evident by the fact that we've got a little bit of a, let's see here if I can blow this up, because you guys know oops, I don't want to do that. Where is the thing. Oh, here we go. The slider. There we go. So, we saw, if you recall, the Russell 2000 had a negative 1.95 one-year Z-score, and it's come back to negative 1.68. I suspect next week when we get this data reported again, it will probably have come off a little bit more, but it's still too bearish. The public is still too bearish on the market. Even now, the S&P 500 has just ticked over to be slightly bullish, as has the the Dow. Which I don't remember, was already sort of slightly in the bullish camp, but it's going a bit more bullish now. The NASDAQ is still too bearish. And if you look at the US dollar trades, like the yen, the Swiss franc, and even the euro for that matter, we still see that the market is not fully appreciating that the dollar is headed lower. And in fact, the market is on the opposite of that trade. And I think that's going to be borne out that it's going to be wrong. Now, which is, I've just covered up point number 2, earnings and all of that stuff. I think that's going to translate or begin translating. Sorry, let me get this chart resized. That's going to start translating back into, where'd my earnings go? There it is. Back into, good positive momentum going forward. Now, one of the interesting sectors, of course, that swung nicely positive. We have 21 of the 23 energy companies reporting, showing 16% earnings growth. Like, they were negative in previous quarters and are now showing earnings growth. We've come off a real serious downturn in energy. That trade has started to really work this week. Like, if you've been looking at your accounts, you'll notice that the energy trades, even though we've had a couple of down market days, the energy sector has been ripping to the upside. So that's translated into great positive return so far this month, and that's just flowing through nicely. As has some of the industrial trades and some of the materials. And what's the other sector that I'm thinking of? I can't think of it at the moment. Oh, I've just bought some tech, because tech, as in the Qs, tech had that negative Z-score and had a bit of a sell-off, but is also in a bull market. So we bought some tech this week. Anyway, everything's all going well. I think that's just broadly the theme that you should hook your wagon to, is that things are going well, and I expect them to continue to go well. Now, I want to talk about volume. Item number 3 is volume. Now, this slide, I want to just give you the volume over the last basically 3 trading days, from March 4th, May. I'm trying to get us back to March. I don't want to do that. May 4th, May 5th, and May 6th. And I want you to just look at something. Now, normally volume is a positive number. And one of the things that is interesting about volume and down days, or sorry, what I should say is, the thing that's interesting about the volume metric is that if you are in a bull market, you want to see volume increasing when markets are rising. So in other words, if we're hitting new all-time highs, you want to see volume coming into the market, because it means that people are buying the rally, and it's a good thing. It means that a lot of money's flowing into the market, versus volume that is down or even negative over a prior day. It means that the rally is maybe really tight and constrained to certain names that are just pushing the indexes up. So volume is usually a good indication that you're getting breadth and depth in the participation of a lot of companies, in this bull market rally. Commensurately, when you have a sell-off in a bull market, you want to see volume metrics that are declining. So what that means is, if you look at this volume, which was pretty light on the prior day, it wasn't up a lot on the prior day on May 4th, but the biggie was on May 5th, when we had a bit of a sell-off. I think we had a bit of a sell-off on May 5th. I'm just going to check. You can't see it because it's on my other screen, but I'm just going to check May 5th. Yeah, we started a bit of a sell-off on the 4th and 5th of May in the Russell and in the S&P, I think. Yeah, the S&P had a big down day on the 4th and 5th of May. Big down day on the 4th and 5th of May. But look at the volume number. It was down a lot. And this tells you, and then it was down again significantly. This was volume on the 5th of May significantly. So anyway, what this means is that the downturn didn't have any sort of conviction. The volume was light, and volume is a big input into the price volume volatility measurements that HedgeEye uses, in that when you have a bull market that has a bit of a sell-off on declining volume, it doesn't mean a lot for a continued downtrend. Hopefully that's making sense. So I guess really to lock off the volume thing, what I'm saying here is it was pretty weak volume. And of course, what we've had, and when I show this next week, I'll see if I can remember to pick the slide for the volume that was on the 7th of May and maybe even on the Monday, because we've had a couple of nice sort of rally days. And we've got some government data coming out. I think it is the jobs number coming out tonight. And if I think they're expecting about 975 or 78,000 jobs created. If that number, has a 1 million in front of it, that's going to be probably, a further sign of the economic strength that is returning to the market. Anyway, so what I'm ultimately saying, and I'm just going to grab the trading screen here and drag that over, see if I can do that. So we can just quickly cover off some of the usual suspects that we discussed. So that should work pretty well for you. There we go. So I guess what that volume conversation means is that the health of this bull market rally is intact. And I am fully anticipating and expecting, as I've said in previous updates, that we'll continue to see this rally unfold, and particularly in the sectors that we own. So industrials, materials, energy, financials. That's the other one I meant to mention, financials on the earnings. They had ridiculously stellar financials. So, rising interest rates, as I think I've mentioned in previous updates, means more profit for banks because their margins expand. So no big surprise, their margins and their profits are up. Anyway, just quickly to touch on a couple things. Volatility indexes. We've had a very interesting situation because we've kind of bounced between about 17, high 17 to 19, high 19 vol. The range has tightened a little bit. And when the range tightens, it usually means you're in a consolidation type phase. It's when the range really widens a lot that kind of spells trouble. But the range has tightened quite a bit into about a 3-point range, but it continues to be in a decline. Volatility continues to be in a decline. And so again, the term we use when we see these spikes in vol, and I'll actually just click on the VIX table here and show you the daily. We've seen these little spikes in vol here, but it's closed well below the high of the day. And again, that is episodic and non-trending. It's sort of this Brownian motion that just happens in markets, but it doesn't really mean anything. It's the market having some sort of mini panic over something. Who knows? It could be some comment that some central banker made or whatever. Like Janet Yellen came out, I think it was on Wednesday of this week, possibly Tuesday or Wednesday, and said something like, we're going to have to start looking at raising interest rates. And then, that's probably this spike or this downturn you saw on the 5th. And all of a sudden the market reacts, of course. And the next day she has to come out and sort of walk those comments back. So anyway, it's just quite fun. I'm laughing because it's just funny that they try to say things and whatever, the market throws a hissy fit and then they walk all their comments back. So anyway, that's really all I've got to say right now. We are absolutely in, I'm just going to go back to my bubble here. But I just want everyone out there to know that we're absolutely in a bull market right now. And all of these little opportunities that come along, if I have cash to deploy, I might buy, top up some positions, whatever. But really, I'm pretty well set for positions right now. I'm very happy with portfolios. I'm very happy with what we own. There's one or two things that are being a bit of a problem child out there. And I might maybe next week I'll do a position update for everyone just to give you an update on where we're at with individual positions. But by and large, the macro positions that need to be working right now are working beautifully. That's energy, again, materials, financials, industrials, and a little bit of the pot stocks, the Russell 2000. What else is in there? Our Aussie positions as well. The Aussie market, a lot of the dividend plays, the sort of big market exposures. Anyway, as I say, I'll go through a position update next week. And then I've got a few individual stock picks in there that are actually doing okay. As I say, there's one or two problem children in there that I'm going to keep monitoring, of course. But overall, I'm very, very happy with performance. I was just doing a review on client accounts over the last couple of days. And look, most accounts this month year to date, I should say, year to date are up somewhere between sort of 11 and 13 or so percent. Some of that will vary based on the size of your account and some of the legacy positions that might be in there from transferring over from Macquarie trading. But in any case, we're having a very good year. That's a great performance metric for basically a long-only portfolio into the first, and we're not even halfway through the year yet. So I actually really think May and June could be quite significant in terms of watching the oil price and seeing what that does to energy companies. And look, I'm not promising anything. I mean, anything can happen, of course. But at this stage, it's a great setup for the continued inflation trade. So that's really all I want to say. This doesn't have to be a particularly involved market update. I think you get the gist. From me, the consistency with my message, I do hope, I dare say, is has come through beautifully consistent and loud and clear. Bull market, reflation, inflation, and just stick with the process at this stage. So on that note, I will say have a fantastic weekend. Thank you for all your support to everyone. If you do have any questions about your individual portfolios, feel free to give me a shout, and I'll either set up a call with you, which again, you can go to the boardroom. Hopefully everyone is a member of that boardroom. If you're not, jump on Facebook, find the boardroom. You'll see my photo there. And it'll some Keystone Financial stuff, and you can request a membership or request to be added to the group. And from there, you can go to Calendly, which is a booking tool that you can get access to my calendar and book yourself in for an appointment. So please feel free to do that if you do have any questions. Other than that, I am really, really excited about how things have been going, and I will come back next week with further updates. Have a great weekend. Bye-bye.